Welcome back, everyone. We're diving into a brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. If you're someone who really loves getting into the weeds of accounting, figuring out exactly how these complex financial instruments get reported, well, you are in the perfect place. Today, we're going to unpack a super interesting case study involving Ind AS 109 and contingent interest debentures. So, let's just jump right in. Here's our roadmap for today. First, a quick welcome and why this all matters. Then, we'll look at the debenture dilemma itself, followed by the rules of Ind AS, the final verdict, and finally, disclosures and our next steps. Now, you might be wondering, why should an investor even care about accounting standards? Well, it's pretty simple when you think about it. If you're putting your hard-earned money into shares of a listed company, you absolutely need to understand how those numbers are put together. These standards dictate how profits, losses, and a company's true financial health are reported. Basically, if you don't understand the rules of the game, you can't read the scorecard, right?
Okay, just to set the stage for today's analysis, let's get our foundational context straight. Our functional and presentation currency is the Indian rupee, meaning any other currency is considered a foreign currency to us here. Our reporting period runs from April 1st to March 31st. And really quickly, I do need to mention that the views expressed in this explainer are entirely the personal views of the author. They aren't binding, so please always seek out expert help before taking or refraining from any action based on what we're talking about today.
And, navigating these tricky rules is exactly why the Gap Advisors ecosystem is such a lifesaver. The issue we're tackling today actually comes straight out of the huge issue repository over at gapadvisors.com. We're talking over 4,500 issues and responses on Ind AS and Indian GAAP. Literally anyone can register for free, submit an issue, and get a detailed response delivered right to their inbox. It's a game changer, especially for auditors who need to rigorously document exactly how they addressed an Ind AS application issue. Plus, today's case was actually featured in the 198th edition of the Gap Advisors Task Weekly newsletter that's authored by C.A. Monish C. Iyer, director at Gap Advisors, and published on LinkedIn. They've put out over 230 editions so far, so if you're registered on LinkedIn, definitely go subscribe to that for free.
All right, Section 1, the debenture dilemma. So let's lay out the facts of today's little mystery. We've got a holding company that invested in 10-year 9% non-convertible debentures, or NCDs, issued by its own subsidiary. But here is the catch. The investment agreement states that the 9% interest will only accrue and become payable if the subsidiary company makes a profit. Right now, the subsidiary is making losses. They're estimating they'll turn a profit starting in 2022. And once they do, they have to pass that interest expense entry all the way back from day one of the subscription. So, here's the million-dollar question. What does the holding company do right now? Do they have to recognize that interest income from day one, even though they have zero certainty about actually getting it? Or do they just wait patiently until the subsidiary actually turns a profit? It is a classic accounting standoff.
That brings us to Section 2, the rules of Ind AS.
To solve this, we have to look at the rule book. Paragraph 5.2.1 of Ind AS 109 deals with financial instruments. It tells us that after initial recognition, a company has to measure a financial asset in one of three ways. Path 1 is amortized cost. Path 2 is fair value through other comprehensive income, or FVOCI. And Path 3 is fair value through profit and loss, which we call FVTPL. So how on earth do we choose?
Well, the gatekeeper to those paths is what we call the SPPI test, found in paragraph 4.1.2. SPPI stands for solely payments of principal and interest. For an asset to be measured at amortized cost, it has to be held in a business model strictly to collect contractual cash flows, and those cash flows must be SPPI. Think of principal as the fair value at day one, and interest? That has to just cover the time value of money, credit risk, and basic lending risks. If your contract is more complicated than a basic loan, it totally fails the test.
The contrast here is super important. Amortized cost requires you to pass that strict SPPI test and have a hold-to-collect model. It's meant for your plain vanilla, highly predictable loans. On the flip side, FVTPL is the default fallback. According to paragraph 4.1.4, if a financial asset doesn't qualify for amortized cost or FVOCI, it automatically goes to fair value through profit or loss. If it fails SPPI, it lands here, period.
Which leads us to Section 3, the final verdict. Let's apply this framework directly to our holding company. Step 1, look at those contractual cash flows. The interest on these 9% NCDs is totally contingent on the subsidiary turning a profit. It doesn't even say if anything gets paid if they never become profitable. Step 2, because the payouts hinge entirely on the subsidiary's financial performance, this is definitely not a basic lending agreement.
So, step 3, the terms do not give rise to cash flows that are solely payments of principal and interest. Boom. It officially fails the SPPI test.
So here's our final ruling. Because it fails the SPPI test, the holding company is required to measure these debentures at fair value through profit or loss, or FVTPL. They have to recognize the changes in fair value directly in their profit or loss statement. They absolutely cannot just smooth it out and recognize interest income using the effective interest method from day one. Doing it this way ensures the accounting actually reflects the true underlying risk of the instrument.
And finally, Section 4, Disclosures and Next Steps. Okay, so we know the accounting treatment, but transparency is key here. Under paragraph B5 of Ind AS 107, which handles financial instruments disclosures, the company must disclose exactly how they determine net gains or losses. More specifically, they need to state in their accounting policies whether those fair value gains or losses running through profit or loss actually include the interest income. And they also have the option to separately disclose the interest receipts from the other fair value changes, which honestly gives investors a much clearer picture of what's going on.
Now, if you're pulling your hair out over complex Ind AS or IFRS issues like this in your own work, you don't have to figure it out alone. You can actually book a one-on-one consultation to hash out your specific issues directly with the author, CA Manish C. Iyer, over on his topmate.io page. And definitely make sure you follow the Gap Advisors Ind AS Clinic channel on WhatsApp. It's literally the best way to get instant updates on all our explainers, podcasts, newsletters, new standards, the whole shebang.
Thank you guys so much for your time and focus today. If you found this explainer helpful, please do hit that like button, drop your thoughts in the comments, and subscribe to the Gap Advisors Ind AS Clinic channel if you haven't already. We'd also love it if you share this explainer with your contacts, your colleagues, audit and finance teams, and especially CA students. It really helps spread the knowledge of Indian accounting standards.
We've covered a lot of ground today, but if you want to explore the real-world nuances of this exact issue even further, I challenge you to keep digging. Go check out the Gap Advisors Ind AS Clinic podcast on Spotify, Amazon, or YouTube for a much deeper audio dive into this topic. Thanks again for learning with me today, and I'll see you in the next explainer.